Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields continue the climb. Their highest level of this move getting up to 262. Recall back in March we were 263. In December of 16, 264. Got to go back to SEPA 14, 265. So we're kind of at a critical tipping point here. Will we get through this level? We'll call it 265 and push onward. You got to go back to 2010, the last time we were at 4%, which seems a lifetime away, but kind of gives you an idea of where the market's been. This is pretty much the high of the range going back several years. And it seems to be getting some momentum here. Now, if you look at where we could pull back to, with yields right north of 260 now, this is kind of going to become a level where we maybe build a little bit of sustainability. However, with the Fed talk and with the inflation talk and with the trend, and I think a lot of positioning, to be honest here, that you could see this continue up to 275 in 10-year yields relatively quickly. It's all going to come down to, will the inflation numbers push through to fruition? Will the Fed be fearful of that happening? The Fed is really not given a whole lot of credence to that, and then there's the curve, which remains very, very flat. So on these moves out of the range, kind of new ground, at least since last March, what would you expect volatility to be doing? Well, volatility is up slightly. It's been up slightly this week. However, we're just back to unchanged from the end of the year. So year to date, it's only been about 18 days, but year to date, we're talking unchanged in volatility, which I think is a good thing. The trending lower theme that we had in 2017 possibly could be gone. We hope. We can only hope that. We saw a bid to equity volatility this week. We haven't seen that reflected in rates. So right now there's really no fear of rates, despite the fact that we are trading outside the range, because we are trading in a new trend, which is just up. So if we see a moderate pullback lower in yields, that could bid volatility. So lastly, let's look at the curve. The Treasury curve has been the thorn in the Fed side, along with low inflation. When we talk about the curve, the 2-10 spread, getting down to decade low, it's right around 50, and then it creeps up to 55, and everybody starts talking about the yield curve getting steeper. Well, if you look at the numbers, the Fed is really priced in the market is priced in 2 rate hikes this year from the Fed. So that's 50 basis points in the short end. You could see the Fed, push rates higher. What does that do to the 10-year yield? Well, the 10-year yield right now at 50 basis points over the 2-year to 55, that really puts them at pretty flat if we continue to see the same theme and same scenarios we've seen thus far. Low inflation, uncertainty. I think there is still a demand for yield, despite the fact that we are seeing equities at such elevated levels, and there is still that uncertainty globally, the flight to quality bid, whatever you want to call it, that's keeping Treasuries bid, and the positioning wise for higher yields has worked, although it's been very slow to fruition to come. We haven't seen that real push through and onward. Even in the 30-year, we haven't seen it. So right now everything's just slow and steady. And the yield curve reflects the uncertainty of the market. It reflects the fact that we could be hitting a very flatter yield curve based on what the Fed's doing, unless the back end of the curve gets to the programs. Right now, the curve, a couple ticks higher and steepening today, but certainly still on those lows, volatility low. But we are seeing yields trend higher. So right now, that is the case in bonds. We have one more day to end out the week. And looking forward, I think the biggest event on the calendar for rates right now, we have FOMC. We've got the President's Address, State of the Union, then we've got FOMC at the end of January, and then let's not forget that in February we're going to get the entering and the beginning of the Powell era of monetary policy, and with that will come his first semi-annual testimony to Congress. So I think that'll come probably in the 3rd week of February. It hasn't been scheduled yet, but that will be some dates to look forward to. I think he'll address the curve specifically, as well as the other Fed mandates, but I look for him to probably separate himself from what Janet Yellen has done over the last several years, and that is to talk slow and steady. Let's get this thing moving, and she kind of played off the curve being so low and being so flat at December FOMC at the press conference. So I think he probably looked to maybe act on that a little bit, try and goose those back end yields higher than they already are. So this is Todd Colvin coming to you from the floor of the CME Group.